Joining us now are two trailblazers who are rewriting the narrative on African venture capital. First, with me, right next to me, is Amaka Okechukwu-Opara, founding partner at Wave Capital, who has managed over $1.4 billion in financing projects and is driving investments in female-led ventures to bridge the gender financing gap. And of course, Dr. Ola Brown, who is still with us in the studio, founder of HealthCap and author of Journey to Series A. She brings a unique perspective at the intersection of VC and social infrastructure, with investments spanning nearly 30 startups across fintech and health tech. Great to have you both on this discussion, which I'm really excited about. First of all, I'm actually really excited that more and more women are getting into the VC investment space. So you're actually really trailblazers. Good on you. The first thing I wanted to chat about very quickly was looking back at 2024, and I'll start with you, Amaka. What the key takeaways for you for venture capital in the Africa startup ecosystem were?
Thank you, and lovely to be here. I think the big thing, I think for most people, was the fact that effectively capital is not finite, right? And so there needed to be a recalibration in terms of how businesses operated, with that knowledge in mind that you have a certain finite time to profitability. And I think that was one big takeaway. Another was really just the focus on, the full cycle. I think the venture capital ecosystem has been, is reaching that 10-year mark. And people are starting to say, where are the returns in terms of the distributed capital back to LPs? And so there's increasingly a focus on actually less in terms of paper valuations and actually more in terms of distributed capital back to LPs. So I would say those are some of the two critical shifts that we've seen.
Yeah, and of course, for the benefit of our viewers, LPs being the investors in your fund.
Exactly.
Yeah. Okay, so Ola, what about you? What was your big takeaway for 2024?
So 2024, I think, was interesting because I think it was an evolution in the venture capital landscape in general. So I raised my first fund in 2016. So returned
almost a decade ago.
Yeah, returned 5 times money to investors by 2020, and that was one of the best returns on the continent. So I think that the venture capital ecosystem started really evolving in terms of manager selection. So looking at managers with track record who have returned money to investors and differentiating that from sort of the poorer returning managers. So that was the first thing. The second thing I think was around different specialization. So the first era of firms were all very generalist firms that invested in all different sectors. But we at HealthCap decided for our second fund just to focus on fintech and health tech. I think that this has been something very, very common in America. So American firms are highly differentiated to the extent that even within health tech, they have you can have $1 billion biotech firm, which is a small segment of health tech. So sector selection and manager selection became really, really important. Whereas I feel like in the era of free money, 2020, 2021, we spoke about when there were 0 interest rates and people could not invest in fixed income. Sometimes there were negative interest rates. So of course, people could not do fixed income. So venture was just like, let's just give money to any other asset class so that I'm not effectively losing money. Manager selection became very important. And then because there were a lot more mega funds raised, I mean, Partech, for instance, raised $300 million. There's a lot more institutional funds in the ecosystem. So manager selection now became very, very important. Looking at track record, really scrutinizing both on the manager side and on the startup side, what actually makes a good African startup and what kind of fundamentals do they have to have to really go through an institutional due diligence process to be able to get funding. And I think that was synonymous with our earlier discussion about interest rates rising and just people becoming more selective in general.
And you make very good points, but I've always questioned the strategy of having such specific sector specialization, because I'm hearing a lot of funds now coming to Africa and saying, actually, we don't just want to do Africa anymore. We don't just want to do energy anymore. We want to actually diversify abroad. But speaking of manager selection, one of the most prominent demography of managers on the continent is female fund managers. Tell us about how that is likely to evolve. Obviously, you are, walking examples of that. But, what are you expecting in terms of capital flows for gender-focused investments and women-led funds, for instance?
I think, I mean, it's the future is female. And I think it's really what we say at Weave Capital is that a lot of the times when you're having a conversation about gender, you're really thinking about it as, gender is a screening criteria. And you say, hey, I'm looking at an investment. Is it a male-led company? Is it a female-led company? And really, we see it as gender as an opportunity. There's a huge opportunity that is being left out of the table. And so we see that there's going to be more funding going into these opportunities because we now understand, and I think there's an increasing understanding that when we look at capital allocation, there's been flaws in how we've allocated capital, and there are huge opportunities.
What are some of those flaws? How have we allocated capital that's been flawed?
I think it's really more about excluding extreme groups, right? I'll give an example. When we look at female businesses and founders, they don't get investments because they're female, right? They get investments because their businesses are amazing and they're building, very capital efficient businesses. However, I mean, historically, they've been excluded from the market because of some of the biases that you see. So, for example, you would see in the network effect of, if you see primarily male-led venture capital funds and your network is maybe other male founders, that's who gets funded.
Right.
When you bring in a new asset allocator like female fund managers, you start to see more, in terms of the network effects of actually seeing and understanding more, seeing more female founders getting funded. In addition to that, there's sometimes a bias in industries, right? I mean, I remember having a conversation earlier this year about, what is a VC backable investment and sector. And some, areas where sometimes you see women predominantly in, whether it's beauty, food, are sometimes looked at, or even healthcare, sometimes looked at as these are not VC backable industries. And I think that's quickly shifting as we show more data to support that these are actually strong investments. So I think we're going to see more allocation to this asset class, and not from this is an, nice to have, or this is an impact-driven investment, but because this is fundamental in terms of good investment, and it's chasing and getting that alpha return. So I think we're going to see that.
I'm just wondering if anybody has done any studies around returns on investments that are gender focused, because we often talk about it and how it's impactful. Women are better capital allocation, efficient allocators of capital, but it's the empirical evidence that kind of supports that sometimes I'm missing, because you feel like you're always trying to prove that this is a better way to go in terms of diversity. Yeah. But I ask, show me the numbers, right? But maybe it's just something to think about. I don't know if you have any thoughts on that.
So we're not we focus on healthcare and fintech. Now, from our existing portfolio, 50% of the investments that we've made have been into female founders.
Okay.
And I think
but that wasn't your primary drive.
That wasn't our primary
just
drive.
A byproduct.
That happens because mathematically, if you look at it, Africa is the only continent in the world where a woman is more likely to start a business than a man. In Asia, men are more likely to start businesses. In Europe, men are more likely to start businesses. In America, men are more likely to start businesses. In Africa, actually, there are more female entrepreneurs than male entrepreneurs. Women are more likely to start a business. So mathematically, if you think about it from a pure numbers perspective, you should be making more investments in female-founded companies than probably you would elsewhere, just because the sheer likelihood that you're going to come across them. And so we're not aiming to invest in all female businesses. We're a venture capital fund that invests in the best businesses in Africa. And it just so happens that 50% of them have female owners.
Yeah, so you do healthcare and fintech. Beyond sort of profitability and some of the other standard metrics, if you like, that you look at to assess the viability of investment, are there new types of criteria that are emerging in the current climate that are likely to define the 2025 landscape? And I'd like some thoughts from your perspective.
I think that we're thinking more seriously about exits. So every time we make an investment, we think from the beginning of that investment, where is it going to exit? And as somebody that has had multiple exits now, I've always been quite focused on how is the acquisition or the secondary, who is likely to acquire this, who else can I get on the cap table? So what kind of value add can I add to the company that would make it more attractive to a follow-on investor, a private equity firm, or an acquiring firm? Or how can I list this company on a local stock exchange, perhaps, to get liquidity? So I think that there's been a lot more focus on that, like sort of thinking about that earlier on. And I also think that apart from looking at profitability, we're looking at, is this people are now looking at, is this, what type of business is this? Is this a marketplace? Because marketplaces tend to attract lower valuations than, say, software companies.
When you say a marketplace, sort of, what do you mean?
So when you have a pure software business, I'll use the example of the perfect tech business, which is Microsoft. You pay for the same Microsoft every year, and you're paying for the software. Whereas with Uber, you're not paying for Uber software. You're paying for the service that the software can give you. Okay. So pure software companies typically attract higher valuations than marketplaces, for instance. But there's also been big pressure on valuations. I think the valuation is a bit of an art or a science, but I think there's been a shift in the past 3 years from being from the arty side to more of the science side, where we're really saying, can we justify those valuations right now? And what happens when you invest in a company at too high a valuation is later down the line, when they don't hit that target, they go through what's called a down round, which is bad for everybody. It's bad for the founder because they own less of their own company, and it's also bad for the investors. So there's been a big focus on valuations and making sure that we're investing sensible valuations that companies can continue to raise, because overly high valuations were seen as good for the ecosystem, but actually we've discovered that they're bad for almost every player in the ecosystem when you invest at inflated valuations.
Amaka, do you want to comment on that? Or
no, I think we've seen, I think for me, it's a good move in the industry that we've recalibrated. I think we saw entry valuations that didn't really make sense given the exit options that we have in the market. We had a system where there wasn't enough thorough due diligence being done on companies. I think there was a benefit of 2024 and 2023, where now we're seeing more fundamental-like investments, where people are actually looking at the fundamentals of businesses and really investing over the long term. So I think it's actually a good thing.
And of course, venture capital doesn't exist in a bubble. Earlier on the show, we were talking about sort of the general macroeconomic environment. Sort of looking ahead in 2025, what sort of, enabling business environment reforms, if you like that lingo, do you think will support the growth of venture capital? It's all down to attracting investment into an economy, right? Investment kind of looks at issues across capital, is looking for safety and security. So for venture capital specifically, though, are there things that governments or policymakers can do to really catalyze the sector?
A lot of things. I think most investors, and I think when we're speaking to whether it's people wanting to invest, looking to invest in our funds and our current investors in our funds, and people looking to invest in VC, I think the biggest thing you see is people want to know that if I invest my money today, can I get it out? And that's, I think, the first question people need to answer. And the capital controls are not necessarily helping. I think we've seen massive reforms in terms of the capital controls, but it's not enough. I think it's not sufficient. There is the actual capital controls of the ease of getting your money out of the country if you invest. But there's also the perception. And sometimes, you get that perception from banks where it's like you're hoarding dollars. And that perception that there is a risk to your dollars being held in the country is not a good thing. So I think the first thing is the capital controls. Another elephant in the room is, of course, the exchange rate, and ensuring that if I put money at this price, I can get money out. But beyond that, right, I think in terms of the enabling environments, there's the vacillating regulations that founders are facing. I think you really need to unlock that and really tap into that and say, okay, how can I ensure that people are not just paying taxes, but they're not paying shadow taxes as well? What you pay is clear and it's very succinct. And the last point I'll make is really around local capital. We talk a lot about foreign capital, and we almost ignore the fact that there's, if there's something that last year has shown us is that let's not chase after hot investments, right? Let's look for fundamental people who are going to invest long term, and we really need to activate local capital. Most governments invest heavily in ensuring that, whether giving tax incentives for people in the local economy, whether it's corporates, PFAs, pension funds, to invest in the venture capital space. I think the government needs to think about incentives to really catalyze those investments.
I'm glad you brought up tax, because obviously this year we have the tax reform bill, which, we may not see the full effects of that in 2025, maybe 2026. But I wanted to talk a bit about the Silicon Valley model. We've kind of accepted that we can't be reliant on foreign capital and foreign incubation systems and all of these fancy Y Combinators. But are there still things we need to be learning from that segment in terms of the models that are evolving in Silicon Valley and elsewhere around the world for venture capital here in Africa?
So I think the Silicon Valley and Africa are inextricably linked, in the fact that even when our companies, I mean, we have quite a few seed funds, pre-seed funds, but by the time companies are going to Series A, Series B, we're almost always going to Silicon Valley for funding. And we have a great relationship with the Silicon Valley ecosystem. So I'm predicting that this year is going to be great for Silicon Valley. But by virtue of the fact that it's going to be great for Silicon Valley, it's probably going to be great for the African ecosystem as well, because when Silicon Valley is doing well, we just tend to do well as well.
Yeah.
Because there's a lot of links from Stanford University, alumni, from sorts of people that live in San Francisco, Nigerian diaspora, etc. People just end up raising their later rounds, partly from American investors. So I think that there's that relationship there already. In terms of things that we can learn from Silicon Valley, I really think it's around this mindset of massive scale, right?
Yeah.
I think that in Nigeria in general, there was a great article in The Economist that said that, you know, Africa has too many small businesses and not enough businesses of scale. And when you look at the Fortune 500, for instance, there's no African company that is amongst the biggest companies in the world. And you know, I said earlier that 50% of American stock market capitalization is venture capital backed. That means that venture capital is a really important asset class.
So these were companies that exited via IPOs or ended up on the stock markets.
Yes, exactly. So the Magnificent Seven were all venture capital-backed companies. And so if we really want the engine, and we spoke about Britain's sad situation where they hadn't embraced innovation quickly, and because of that, the economy seems to be sort of dragging. So really, I think the biggest lesson that we need to learn from Silicon Valley is about building companies of massive scale and thinking about that massive scale from day one. Like I said, Africa has a lot of small businesses, but not enough big businesses. And I think a key quote from that Economist article is a lot of businesses in Africa are unemployment in disguise.
But I think I was going to ask about the scalability question. I wonder what the tipping point is and what it would really take to, what are we missing for the scale thing? Is it funding? Is it infrastructure? You know, why do we have so many small businesses and such a fragmented ecosystem here? Do you know why?
I think from a MSME perspective, like the micro businesses, I think there are two types of businesses, and I like to sort of separate them. I think there's some, you know, society is run on the back of sometimes small businesses, and I think there's some businesses that are, you know, a mom and pop shop. That's fine, and I think there's a space for that. Now, if I go back to the venture capital space and saying, how do we build scalable, large businesses like a Dangote, and it's like, or Money Point, how do we build these large businesses? I think the first thing is, you know, thinking, you know, you have to think about it on day one. You know, what we find sometimes is that you look at a business and they're building almost like an innovation that does not stand and hold its weight outside that ecosystem. So you can't be building a recharge card business that, yes, it meets a local solution, but globally it's a technology that is going to be obsolete. So I think the first thing is you need to think about it on day one. The second thing, which is I think a little bit contrarian, is that you have to think about the when. You know, I think oftentimes I hear, you know, businesses talking about, I'm going to be in 5 different countries, and I think that's actually sometimes a red flag. You really need to think about sometimes actually being a local champion, and I mean that in a good sense, where you find your niche and you dominate. I think
you build depth there.
You build depth. And only when you've done that do you then think about scaling across borders. And when you want to scale, I think there are 3 things that come to mind. I think the first is systems and processes. Do you have systems for onboarding your clients? Do you have accounting systems in place? And you find lots of businesses do not have systems. The second is data. Are you tracking? Are you a data-driven company? How much data and visibility do you have into your operations? That's the second thing. And the third and last thing is really about local partnerships. I think when you look at success stories of businesses that have scaled, whether it's VC-backed businesses across borders, it's always strong local partners in the markets that you're going into. And I think those are some of the formulas for success when people are thinking about scale.
Thank you, Mike. And Dr. Ola, just a final word, really, in terms of the actual amount of capital we expect to flow, are we going to see larger size ticket deals this year?
So,
Very quickly.
from the global perspective, we are definitely, because most of the venture capital money that went into funds went into like the main 10 funds, the tier 1 funds in America. So they're going to have to write larger tickets because it's hard to raise $3 billion and then be giving 100K to people. It's almost impossible. So we're going to see larger tickets globally.
Yeah.
Now, is Africa going to benefit from that? It really depends on the fundamentals of the startups that are presenting themselves for funding.
Thank you. Sorry I had to kind of race through that. Thank you so much, Okechukwu-Opara and Ola Brown, for talking to us about venture capital. Great to be chatting with you. Thank you.
Thank you.
Well, that's all we have time for Business Week this week. I'm Rolake Akinkunmi-Filani. Let's continue the conversation on X and do have a lovely rest of the weekend.